Hey traders, Ron here, Traders Academy. And as you know, it's our goal to coach and train traders of all levels. Typically we do that through our podcasts, our blogs, our meetups, and our webinars. But a few weeks ago we had the idea to put out through social media a question to all of you asking, what is your biggest challenge or obstacle that's preventing you from creating consistent trading results? And the response was overwhelming. So what we decided to do was take those responses and create a series of mini courses, each one answering a specific response. So we hope you enjoy these, hope you find them informative, and thanks for watching. Welcome to a mini course entitled How to Construct a Covered Put Trade. And our question today was, I am interested in trying a method that was suggested to me regarding a calendar spread, but I need some help to understand it better. The idea is to sell a weekly put and buy another put with a strike price at or slightly below that of the weekly put, but with an expiration date 3 to 6 months in the future. Then keep selling a weekly put against it until it approaches DTE of the long-dated put. So my actual question is, as long as both positions stay out of the money, do I let the weekly put expire and sell a new weekly contract, or do I roll it out to the next week? And my concern is that if I let one leg of the spread expire and start a new one, it may appear that I'm opening a naked position and my account will not let me open naked positions yet. Okay, so if you want to do this with puts, let's look at a current example. So let's use Apple. You want to construct a trade so that if your short put gets exercised, then you would have a built-in profit. So using today's option chain, let's look at Apple puts. So that's what I pulled up here on Thinkorswim. I pulled up a current Apple option chain. Notice it was December of 2019, 6 days to expiration. So based on when you actually view this video, this will probably be outdated, but at the time of making, it was current. So first you want to look at your near-term puts that would expire next week and see where you may want to sell your put. Just get some ideas down here where you might be wanting to sell. Then you want to look at future output and find one that will allow you to sell Apple to someone else at a higher price in the event that your short put gets exercised and you're put to stock. So as you can see here, I'm picking February of 2020, which is 69 days out. So when I looked at Apple table, I found the following setup. Currently, Apple is trading at 275.15, so I would like to buy a February 275 put and pay 1085. As you see here, 275 strike price, and I'd be paying 1085 to purchase that put. That would mean that if I had to exercise that put and force someone else to buy Apple from me, my total income per share would be 264.15. And that's if you take the 275 strike price, which is what you could put it to somebody else at, minus the price you paid of 1085, that would be a net in pocket of 264.15. So now I want to sell someone a short-term put that is below 264.15. So looking at the chart, you could either sell the 260 or the 262.50 put. Either one would work for next Friday's expiration. So now let's look at the 262.50 put. You would collect 41 cents per share for selling that put for a total of $41 per contract in pocket. Now you just wait. If Apple stays above 262.50, then your short put would expire worthless and then you just sell another one. But if Apple ends up trading below 262.50, then you'll have the stock put to you at 262.50 unless you adjust the trade. But since your total cost basis for your long put is 264.15, then if you had to unwind the trade, you would exercise your long put. So since Apple was put to you at 262.50, you can now exercise your long put and put it to someone else at 275 minus the 1085, which was 262.50. And you'd get a profit of $165 per share, or a total of $165 per contract. So again, your cost basis is 264.15. The short Apple was put to you at 262.50. You can now exercise your long put that stock out to someone else at 264.15. So 264.15 minus 262.50, that means $1.65 per share, or a total of $165 per contract. So if you construct the trade correctly, then if Apple stays where it's at or moves up, then you just keep selling puts against your long put each week. If it moves down and you get the stock put to you, then you would just exercise your long put. Since you have a built-in profit, that would be perfectly okay. So the only problem would be if Apple moved up too much, then you'd not be able to sell puts that were above your 265.15 cost basis of your long put. Or if you did, then you'd be setting yourself up for a net debit trade if you had to unwind the trade, and that's not something you want to do. But as we all know, stocks tend to move up much slower than they go down, so it should probably work out, but you still have that same risk. So your best bet would be to look for good stocks that tend to stay in a range or trade flat. In other words, good old boring stocks. So I do these trades every week, but I do them with calls, not puts, and it tends to work out very well. But for me, my risk is that the stock will go down too much. And of course, your risk is that the stock will go up too much. So keep in mind that there are a few adjustments that you can do to these trades to keep them healthy, even if the stock does go against you. But that would be too much for this mini course, so we'll probably tackle that in a future date. Also, don't forget that for each week that you get to collect your short put premium, that will continue to lower your cost basis for the trade. So each week you sell a short put, you're bringing in money, which is going into the total, which will lower your cost basis. And we haven't talked about this type of return yet, that you would be getting with this kind of trade, so let's do the math for that. So assuming that your stock does not increase in price too much, you could assume that you would collect about the same premium each week for selling your short put. So you collected 41 cents per share for your short put for a 1 week expiration, and again that would be $41 per contract. You paid $10.85 per share for the long put that you purchased, and that would be a total of $1,085 per contract. So that would result in a 3.77% return for the first week. And like I said, if the stock doesn't run away with you, you could expect to do about the same each week. And this, of course, would be on top of the $165 per share or the $165 per contract profit that you have built into the trade in the event your stock drops in price and you get the stock put to you and you end up unwinding the trade. Now, in closing, I do want to point out that it's a fact that the markets move up far more than they move down. Usually the down moves are just corrections in the overall uptrend. So let's look at a chart of SPX going back 20 years, and that's what we're showing here. Now, looking at the chart, what would you say the trend was over the past 20 years? I think correct, it was up, with random corrections along the way in an otherwise upward trending market. So I want to point this out because, like I mentioned, I like to do these trades using calls because by doing this, that way my biggest fear is that the market goes down. But based on this chart, I think you can see that over a 20-year period, the trend has been my friend because it basically goes up, not down. But for those of you that are trying to profit from this type of trade using puts, then if your fear is that the price is going to move up, then I'm afraid the odds are going to be against you. One thing I would like to point out is that once you learn this trade, you might want to keep it in mind just in case we end up having another year like 2008. And in case you're too young to remember, during 2008, the markets lost about 50% of their value. So during a prolonged downtrend like that, this trade would have worked perfectly. And although it's not likely that we'll see another repeat of 2008, we still could see other extended market corrections. And if we did, this would be the perfect trade for that time whenever it does arrive. So by learning trades like this, then you should see that bear markets are not something to be afraid of. All markets present their own kinds of opportunity, and it will be your job to learn trades that will perform well in each type of market. So I hope this helped answer your question. Again, be careful when picking the right stock to do this trade. You might also want to look for stocks that are at new 52-week highs or are trading up against resistance or in overbought conditions on RSI. And by picking those types of stocks, you will have a higher chance of them pulling back. Since you're using puts, that would be what you want. Always remember that in these trades, the max you can lose is the price you paid for your long put. And that amount will be reduced each week that you collect the premium from the sale of your short puts. But in case all of this still seems too large of a task for you to take on, I would like to suggest another option for you. Instead of taking all this on by yourself, maybe consider coaching. Coaching is something that's used by every successful professional out there. At the same time, it's something that's almost never thought about for the average person. But, think about it for a second. Golfers have coaches, boxers have coaches, sports teams have coaches, skiers have coaches, actors have coaches, even rock bands have coaches, and the list could go on and on. And one thing that you may not know is that traders have coaches too. In fact, I can promise you that all successful professional traders have coaches. In fact, all large brokerage firms employ in-house coaches to support their in-house traders. And in fact, when I worked on Wall Street, I used their in-house coach all the time. But whatever path you decide to take, I just want to encourage you not to give up on your dream to become a trader. There is not another business in any field that has the potential to produce the kinds of gains possible as a trader. Remember, it's all about following the process, breaking it down into workable sections that you can tackle with ease. And remember, if you don't feel like going it alone, consider coaching. We want to thank you for watching. We hope you enjoyed it and hope that the information that you got can in some way help improve your trading. And if you'd like to watch the entire series for free, all you have to do is go to tradersacademy.org. That's tradersacademy.org. Fill out the form, give us your email address, and we'll send you a link to the entire series. Plus, we'll give you a free copy of our Reprogramming the Trader's Mindset book, and we'll give you access to a free 1/2 hour private coaching session. So if you'd like to take advantage of this offer, again, that's tradersacademy.org, tradersacademy.org, and thank you for watching.